All right, so we are slowly drawing closer to the end of the conversation on marginal costing and the absorption costing. You know, we have had two sessions just talking about marginal costing. We also had one session talking about absorption costing. But as for today, I just want us to focus on, absorption costing, and we are concluding by looking at the example of using June. We'll use June for our example as we conclude. Yeah, so we are still looking at absorption costing. In the previous class, we had absorption costing, that was on Monday, but we were using the data for May. We used the May data, but as of today, we are using the second month. Yeah, the difference will not really be so huge, but it's important that we also look at this one because there are some minor differences that you have to pay attention to when you're looking at this, and then we'll be fine with this topic, profit and loss, basically using the absorption and marginal costing. Then we'll be due to the transitioning, where we'll have to look at the other topic like absorption costing. What's this overhead costing? We'll have to look at. All right, now having looked at all that, am I even recording the session? Yes, I'm recording the session. So we want to focus and start looking at absorption costing. And I have one question before you that I need to actually read for you. So the question is reading, absorption, the public limited company manufactures and it does sell a single product. The following the following is the budgeted and the actual information that is actually provided in relation to the product that this company is producing. And so you have this data that pertains this particular company. So now, riding on the same data that we have, we are told that the fixed production overhead is budgeted at 4,000 per month, and it is actually usually absorbed using, what is this? It is absorbed using unit basis. And the normal level of production is budgeted at 4,000. Then we are told that there is no opening inventory for the month of May. But since we are looking at the month of June, then there will be the opening inventory for the month of June, okay? The same closing inventory that we had in the previous month, that is in May, shall be our opening inventory in the new month. Now that this is absorption costing, I already said that the first thing that we need to do is to begin by working on or doing some workings on where we establish under absorption and the over absorption. So we need to check whether there was an absorption or over absorption. And for us to know whether there was an absorption or over absorption, first of all, we need to know the actual rate at which the overheads were being absorbed. Now, the absorption rate, listen, absorption rate for the overheads is given as follows. Overhead absorption rate is actually given as the total overheads, the fixed production overheads themselves, divided by the basis that you are looking at. If you are told that it is absorbed based on machine hours, then you divide by the number of machine hours that you have. If it's by labor hours, you divide by the total number of labor hours. But in this question, we are told that the absorption is done on the basis of units. So you divide by the number of units in case of that. This is actually determining the rate at which we are going to absorb the overheads. All right, so we go ahead, we are told that the fixed production overhead is 4,000, divided by the number of units that are available for absorption, and this is 400, so this gives us 10, all right? So 10 is actually the rate at which the overheads are being absorbed. But once you're done doing, finding the rate at which the overheads are being absorbed, then we can now go ahead and find the actual find under absorption or over absorption. The actual, overhead, we are told that is 4,000, right? In the question. But the absorbed, all right? The absorbed overhead was absorbed based on the rate of 10 kwacha. So you say 10 multiplied by the number of units that were produced in June. How many units were produced in June? Are we able to just mention the units that were produced in June? Can you see them? Are you able to see the units that were produced in June? You can't see?
308.
380. Thank you. So 380. So when you multiply, what do you find? I think this will be 3,800, right?
Yes.
And then when we do our computations, where we are deducting, we need to deduct the absorbed. We take the difference between these two, So absorbed minus the actual, what do you find?
200.
Sorry? 200.
200.
Oh, it's just 200. Right. Interesting. So it's in negative 200.
It's negative 200.
Yes, negative 200. So now the question that we ask the class, is this under absorption or over absorption? What did we say last time? Is this under absorption or over absorption? All right. So this is under what? Under absorption. We say that when the absorbed amount is smaller than the actual amount, then that is under absorption. So we have an under absorption value of 200. Is that clear? 200 is our under absorption. Now that we have an under absorption of 200, then we can go ahead and start answering the question, isn't it? Very easy. We can go, and we always start with revenue. We are doing the absorption, overhead, absorption costing. So multiply the units, the selling price per unit times the units that were produced, which is 380 times 50. What do you find as the revenue? We can do this quickly, I think. 380 times 50. We find the revenue.
19,000.
19,000. Is everyone finding the same? 380 times 50. Oh, which one is the selling price? Sorry. Because the units that we are sold is 500.
It's 500.
It's 500. Those are the units that we are sold. So 500 times the selling price. Yeah, that's good. It's good that you're following. When you're finding the revenue, you multiply the selling price times the units that were sold. So it's how much? What do you
25.
find? 25,000, right? So that's 25,000. Then from there, we go ahead and less what? We less the cost of what? The cost of, cost of sales. And remember, we said under cost of sales, you start with opening what? Opening inventory, all right? And the opening inventory is basically the closing inventory from the previous period. And when we are doing for May on Monday, we said the closing inventory was 5,200. That's what we calculated as the closing inventory. So the closing inventory for May shall be the opening inventory for the other month. And then we can go ahead and do direct material costs. DM costs. Direct material costs. How much is it? It is 8 kwacha per unit. So 8 times the units that were produced, that is 8 times 380. What do you find?
3040.
3040. Okay. And again, you go ahead and say 5 times 380 for direct labor.
19.
1,900. What about 3 times 380 for variable production overhead?
1140.
1140. Plus the fixed production overhead that were absorbed. You remember last time we had that issue, right? The absorbed one. We said it was what? It was being absorbed at 10 kwacha times the units that were sold, 380. This gave us 380, isn't it? 38. So you can add these. You can add these. What do we have? Hello? 3,040 plus 19 plus 1140 plus 38.
9880.
98080. Everyone is agreeing as a cost.
Yes.
Yes. Then from here, what did we say we do? You less the closing inventory, isn't it? You less the closing inventory. And what is the closing inventory? Closing inventory we need to calculate, right? It is the units produced minus those which were sold, plus those that remained from the previous period, multiplied by the cost of production divided by the units that were sold. You didn't hear this, I repeat. The units that were produced, in our case being 380, minus those that were sold, that's 500, plus the units that remained from the previous period. It was 200, isn't it? It was 200 units because they produced 500, then they just sold 300 in May. They produced 500, they just sold 300, so they had that difference. So all that divided by, what is this? The units that were produced, which is 380, and on top divided by the cost of production, which is 9880. What do you find? Let's work out the denominator, what is inside the bracket. 380 minus 500 plus 200. What do you get? $380 minus 500 plus 200. What do we get?
Eight.
It's just 80, right? So now that's 80 multiplied by the cost of production, which is 980.80, and divided by the production units being 380. So what is the closing inventory? I guess you are following on how you are setting the closing inventory, isn't it? In the second period, right? So it shall be the same thing that will happen in the next period. If we had maybe another month, let's say July, the closing inventory would have been the opening inventory, and it's the same pattern that you follow like that. You determine the closing inventory thus. So what is the closing inventory in this case? When you do your computation, what do you find as the closing inventory in June?
2008.
2080. Like this. Hope everyone is finding the same. Right. What is the difference now? Take the difference. Cost minus the closing inventory. Cost is what you're going to push in the middle column here. Was it 9880 minus 280, 2080? What do you find? The difference shall be added to the opening inventory. What do you find?
7,008. 7,800.
7,800, isn't it? Now,
Yes.
7,800 can be added to this opening inventory.
$13,000.
13,000. So it is actually 13 pin, negative 13 pin. Now, negative 13 pin to this, we can deduct. What did we say about under absorption? We deduct, isn't it? Yes, we don't add, it's negative figure. So under absorption is put here as a difference. So you will see that this under absorption will push upward the cost of sales, so that under absorption can reduce the profits. Over absorption increases. It's something else. So now, can you do the deduction, like this deduction? What's this? 25,000 minus 13,200. 13,200. What is the difference? What is the difference?
$11,800.
11,800. Isn't it? If you don't want to do it like this, you can just first of all say gross revenue minus this 13,000. Then from that figure you find, you deduct again, the way how we did it last time. From the figure you find, you can now less what? The under absorption. Then you find this still the same answer, which is the same actually. So the same. So in short, deduct this figure. When you add this opening inventory to plus this figure, push in the last column. Can you deduct this figure from the revenue? then the answer that you find, you can deduct again from that answer the under absorption is negative. Yeah, then you find that you have the gross, what's this? The gross profit. So this is our gross profit. Okay. Let's go ahead now and find the net profit, since we already have the gross profit. What do we have? So gross profit is equal to what? It is 11,800. And what do we do from here? We can now deduct all the non-factory costs. Non-factory costs or non-production costs, both fixed or variable. Okay. We can even start with the variable non-factory costs, such as the variable sales commission, 5% of sales. We can do 5% of our sales. Our sales were how much? Well, 25,000, right? What is the 5% of 25,000? It's a variable sales commission. This one.
1,250 kwacha.
1,250 kwacha. Okay. Then when you go ahead and deal with the remaining is fixed selling. Fixed selling is 4,000. We also have fixed admin. Fixed administration cost, which is 2,000. Add all these costs. What do you find? And you push in the last column. This should be 7,000 what? 250. Right? And that can be deducted from gross profit so that we can ascertain the net profit or the net loss. What do we get? The difference. Gross profit is 11,800 minus 7,250. What do we find? What do we find? What is it that we find?
4550.
It's 84.
50. 4550.
Or 4550. 4550. Everyone is finding the same. It's a positive figure, so it shall be profit, right? Not net loss, but it shall be profit. But if it were negative, you could have said a loss. So this is how you deal with the absorption costing. I guess this time around, the absorption costing should be easier to us, yeah? It has to be very easy to us and very straightforward.